Hi everyone, welcome back. Happy Sunday. I hope you had a wonderful Saturday and you're feeling better and you're recovering from your revelries of last night. So, Dhana has brought something which has been cooking in his mind, and since I usually talk to him about the topic before we start recording, and we kind of lose the steam when we start recording, I told him today, no, hang on, let's not discuss before the video starts. We will discuss in the video itself so it looks a lot more fresh than something stale. So then I said, okay. So he's been holding it for me. I don't know what we're talking about today. I'll be finding out as you are finding out watching this video what we're talking about today. So what is it, Dhana?
Sir, today we are going to cover about tech stocks, sir. So during this little correction also, the tech stocks only going in the another way. Like all the stocks are in the red zone and the tech stocks be in the green zone. So they are moving up. So tech stocks are doing something better, I think. So right now the consideration of our state, it will be in the list or not. I need to clarification from that, sir.
Okay. Tech stocks in India. First of all, you have to understand the IT industry in India. The IT industry in India is a services industry. It's not a product industry. Like Google, Adobe, all these big American IT companies, they make a product. Google has a product it's selling. Meanwhile, in India, TCS, Infosys, and all these guys, services, and it's also mainly B2B. They do not actually deal with consumers or customers. And all their solutions and so-called products are services actually, which they give to other companies, usually American companies. Okay. So it's outsourcing, which has developed into this IT sector. So you got to realize this first. There's a major difference when you say IT. If you're comparing American companies to Indian companies. Second thing is, most of the businesses which these companies do are outside India.
Correct.
Right? Indian market is growing for them. Indian companies are requiring IT solutions. Indian companies are reaching out to these guys and they are bridging this. So they're developing. The Indian market domestically is developing for IT. But it's nowhere in the size of what it is for them outside India.
Okay.
Because outside India, not only the American market, which is so huge, they're all over Europe, they're all over...
They are all over the globe.
Correct. All over the globe. North, South America, every single continent, these companies have customers. And all these payments come back to India, to the parent company, in terms of
dollars.
Correct. So they're actually earning in
dollars.
So this is why these companies are considered very valuable, because the Indian rupee against the dollar is always doing what?
Weakening.
Correct. So even if the guy does not make new customers, he has only the same customer base as last year, but his revenue will go up by 10% for doing nothing. He's getting the same $100, but in rupees, it's gone up. Meanwhile, his salaries and everything doesn't go up at the same pace. So if you look at the profitability of these companies, they're highly profitable, especially when the rupee weakens.
Okay.
That's why export companies like this, pharmaceuticals, are considered to be great companies to be investing in when the Indian rupee is becoming weaker.
Okay.
So if you look at specifically into companies, first of all, you can look at Infosys, right? It's a massive company.
Correct.
Right? It's the second largest IT company in India. But the problem with IT companies is in the current scenario, if you see the price to earnings ratio, historically, Infosys 10-year average is 20.1. It is at
27 right now.
So it's a great company. Nothing wrong. But you can't buy it.
In IT stocks, what we need to look for that, sir?
IT stocks, what you look at is mainly debt. Okay, they should have no reason to have debt. Because they don't have any factories, they don't have, so they shouldn't, debt should be low. And the next important thing is the PE ratio. Yeah. So the PE ratio, debt is not something to worry about in Infosys, but the PE ratio is starting to become expensive. The same Infosys was trading at a PE in March last year at 37. It's corrected down. It was in May 2023, it was at 22. At the time, it was a good opportunity. Again, April, maybe it was a good opportunity. Now it's slowly, now it's gone back up. So you have to wait and watch. But you should definitely have it in your watch list.
Yes, sir.
The other famous company is, of course,
TCS.
Yes, Tata Consultancy.
And the second one is TCS.
Yeah, TCS, second one. Okay, this guy is the granddaddy of them. Okay, the problem is again
the 10-year PE was at
25.
Right now it's 32.
Yeah, and the price of each share is
4,000. It's not.
So you can buy 4 Infosys.
Correct, sir.
So if you think about it, you have to consider the growth of this. So my thing is, keep these companies in your watch list. Right? Put them in your watch list. When you saw the market swing the other day, 2 days back, right? The price dropped on that day. The EPS price price drops. Whenever these dips happen, there's an opportunity to think. But these are not Tiffin coffee prices.
Correct, sir.
So this
All the
this
tech
is-
stocks also.
so for this, you should have a separate savings account where you're putting, after your Tiffin coffee, whatever little changes there, your bus money, you keep putting it inside that account and keep it. When these opportunities come once in a year, once in 6 months, these dips happen, then you break that account open and you use it. So that should be a strategy. So these companies, because of the cost of the stock and the way it is, you should only look at it
In a way that what you
when the price is dipping, and also you buy only one because it's so expensive.
Correct, sir.
So this is the idea behind IT companies.
Go slowly rather than the other stocks.
Correct. When it corrects, you should move in.
You should move.
And you should also keep money in reserve because
For
the
this
correction.
stock only.
Correct. Because corrections may just come for 1 or 2 days. Other time you should have the money.
Correct, sir.
Okay. So you keep a separate account like a war chest, and you put little money in that. And when it consolidates, once a year, once in 6 months, you can break it open and use it. That's the only way you can accumulate these companies.
Yes, sir.
Otherwise, the Tiffin coffee ranges, you cannot look at this. And currently, none of them are doing any share split. Where's the face value of this? This is already face value 1.
But Infosys at 5.
Infosys, maybe in some day they might split. Make it again cheap for investors to walk in. Because at 1,700 they split, 1:5 they split it. You will come down to something like 400 rupees, 400, 500 rupees, and you can walk in and buy it.
So for that, with this waiting period, we need to wait for the correction.
Yeah.
And we have the savings account separately for that and put some money on that. And then we need to invest.
Because the size of those companies are that big. The price of the companies
Prices
are.
also
Yeah. So even if you look at another one, like,
take my hand.
yeah, that's 1,500. These are well above Tiffin coffee ranges. And
But
this is, look at the
stock
PE ratio.
Currently over expensive.
It's beyond over expensive. Historical average is where?
19.
Yeah.
Wow. And EPS also not growing, sir.
Yeah. That's because of other reasons. But the company is a good company. But it's going to take time. But at this current price, you have to wait.
You have to. Tech Mahindra is so over expensive. Right now, with that, we are discussing on the 3 stocks.
Yeah. So, what are the company you have know in IT? We spoke about TCS, Infosys.
HCL, sir.
HCL, right. Let's see what is the 10-year average. It says 16, 17.
At initially, I look at the stock PE. Okay, right now it can be a
But price,
consideration. But
yeah, all of them are 1,500 plus, which is well above your Tiffin coffee range.
No, sir.
Yeah. So, this is what I say. You create a separate account, savings account, which you will not use, with no ATM card, no digital banking.
Correct.
And you keep dropping.
Correct, sir. Like savings.
Undi.
Undi.
Digital undi. You put it in that. And then whenever this opportunity comes, you break it undi open and buy what you can. Okay, this is why you'll be able to accumulate these stocks being a Gen Z. Till then, every day do look at value, wherever you see value. In that other companies we have discussed. If you see any value in those, buy it.
If I not to open the separate account for that or any savings like that, if I need to invest for the 2 months of period, that amount I can keep
you can keep buying gold. Let's say you keep buying gold. Right?
Okay.
Once you've accumulated 2,000 rupees worth of gold, sell your gold and buy it.
This is a good idea. I have that 2,000 amount I can keep for the 2 months, and the correction has happened. I can invest that money like that. But your idea is
keep buying gold, milligrams of gold, micrograms. Buy 1 rupee, 2 rupee, 10 rupee like that. Your bus, that's what I'm saying. Bus money you collect in Google itself, digital locker.
Digital locker.
Yeah, then dispose it and buy this. Because when you dispose it, you get it immediately. Okay.
This is a good idea. Seriously, sir, I am not having this idea.
Okay, I'm happy. Today, he actually learned something. Usually, he pretends to learn. Dhana. Today, he's actually learned something. Anyway, I hope you enjoyed this video today. And hope you have a wonderful Sunday and had a wonderful weekend. Get ready to get back to work tomorrow and have a wonderful week, productive week ahead of you. Thanks for watching us on the podcast today. And do think of sharing this with your friends and family, whomsoever you think might find this content interesting. And do like that video. And do turn on the notifications so you'll be notified every time me and Dhana come out to you guys. Thanks for watching the video and see you in the next one soon.
Thank you.